It'll definitely have an impact. And it's interesting the counterintuitive nature of it because, excuse me, most people would expect in this environment for gold to have taken off immediately. And my dear departed friend Jim Sinclair used to say to me, Andy, it's called MOPE, Management of Perception Economics, that they want to manage the perception. They don't want to let gold go to the moon. That would signal the wrong thing and would exacerbate their problems financially. Whether or not people want to acknowledge the fact that these markets are managed by inside interests. I'll tell you that every single time I've seen war, and I've been doing this all the way back to the Gulf War, the very first one, I don't know, in the 90s, every single time this happens, the price gets knocked down into the war. And, the conventional wisdom, it's throwing out the baby with the bathwater because it's very liquid. I think it's more along the lines of managing perception of what is exactly happening. But what we are seeing happening, of course, is a major shock on oil. And as oil gets more expensive, you have to understand that the dollar still is the world reserve currency, meaning every nation on earth needs to accumulate dollars in order to buy oil. And in accumulating dollars, the place to put those dollars rather than leaving them in some account would be to recycle them into U.S. treasuries, which are immediately liquid. And you have to ask yourself, what happens when these nations realize that not only has the dollar gotten stronger for some reason, but so too has the price of oil been going up. These are both moving up in tandem, which is certainly a strain on the bond market. And we are seeing, and Luke Groman talks a lot about this, since you mentioned Luke, you're seeing interest rates on the 10-year start to move in the wrong direction. You're starting to see, I believe, a crack in confidence in the entire system, but you're also beginning to see a form of forced liquidation of U.S. Treasuries simply to get enough money to buy oil, as both are moving up in tandem. And secure oil is something that will never go away in terms of concern by these nations. So ultimately, I think we are witnessing a situation where this entire system is being looked at cross-eyed, and ultimately I think you see precious metals moving up much, much higher. But we'll have to see how long the strait is closed. We'll have to see how this all ultimately plays out. But it goes also very much into what you were saying about your guest who's going to come and talk about China. I couldn't agree with what he's saying anymore. I mean, you have a series of vaults that are being built by the Chinese all around the Belt Road. The first one was just completed in Shanghai. In Hong Kong, which is very important because when gold flows out of China, it has to go out of Hong Kong. The next one is being built now in Saudi Arabia with the intention of building them all around the world. They are building a gold-dominated infrastructure. Ultimately, gold will move regardless of what we see here. And in my mind, this is a temporary strengthening of the U.S. dollar because of oil going higher, because of the dollar being where it is, and the fact that these folks will have no choice, I think, around the globe but to sell treasuries to buy oil. This is a game that you can see is getting close to the end, and will put strain on everything in the marketplace. But ultimately, I think, will be wind at the back for the gold market. Maybe not today, maybe not tomorrow in terms of the immediacy of rising rates and what's happening, but I think ultimately gold will be one of the biggest beneficiaries of a system that is looking at the dollar and the treasury as something that it really never was, and that is something that isn't really trusted globally anymore. We decimated our strategic stockpile, I don't know how many years, and so we're way behind the eight ball there. You look at a country like India, who by all reports, and again, it's very difficult to piece this all together, but a lot of people think it's been well north of 800 million ounces that were accumulated by the Indians over the last several years. And I think it is absolutely non-coincidental. I think that the government has been behind this from the get-go. And I'd say the same thing about gold. I think someone within the Trump administration got to the president and said, this is what's happening around the world with gold and silver. And if we don't understand this and beat them at their own game or get into it very, very, very aggressively right now, this country will will be forever compromised. And so, yeah, I think it is. If I had to guess, I would say the Exchange Stabilization Fund has been involved in this really since the very beginning, because it's not just silver, it's also gold. Since a year ago, November, when he won the election, it's every single month. And just the other day, we saw 2.94 million ounces of silver loaded out in a single day. This is not business as usual. This is the kind of withdrawal that tells you physical metal is being pulled with urgency. And I don't know who's doing it, but it's certainly big. And I think that the paper price is the greatest tool of misdirection. And I don't think people quite understand that. And what I mean by that, let me try and give you what I mean. And let's use gold as kind of the proxy for understanding that. Gold is like, for example, GLD, which is a proxy for the price of gold. But to me, it's functioning more as a deliverable reservoir. So what's interesting about it, the big interests in the U.S. do not need to telegraph physical demand by bidding loudly in the open spot market, because that's what a lot of us can analyze. That's what we've been talking about. But what they can do, and these big money interests would be the APs, the authorized participants, JP, Goldman, et cetera, they can source GLD shares and redeem what's called baskets, which are 100,000 shares minimum, through their channels and receive London good delivery bars.
So you and I can't do this, but these very big players can, right? Yeah.
Right. And so what we saw recently was a very, very large redemption coming out of GLD. And it was like the largest redemption ever in its 20-year history. It was $4.2 billion worth of gold. It was a week or two in a single week, close to all-time high prices, but the largest weekly outflow in its 20-year history. Now, the media will frame that as this is gold at the top, big money is repositioning, they don't trust gold anymore. I look at it very differently. The combination of massive outflows while prices stay stable, and there's been a little bit of choppiness, but the prices have stayed relatively stable. This is exactly why I believe everyone has a right to be suspicious about this, because when price stays structurally strong, but ETFs are experiencing the largest, outflows ever in the history of the fund, to me, to the media, the interpretation is no one wants gold anymore. But to me, somebody wants bars more than they want the ETF exposure. I go back to what Jim Sinclair and I talked about. That's mope, in my opinion. The conventional wisdom is throwing out the baby with the bathwater. And yes, you get liquidity. I have always felt that was just an excuse. Look, if it's a pretty much agreed upon assessment that the metals markets have been heavily managed, right? Call it what you want, manipulation or management, it's the same thing. Then the time to manage it is exactly when everyone is freaking out, because the last thing that they want to see is a dumping of dollars and an escalation of gold and silver, because it shines a light on the fragility of the entire system. And so, yes, we can call it throwing out the baby with the bathwater, getting liquidity. It's the most liquid. You can cover your margins. I don't believe that, because most of the people on margin, they don't have an ounce of gold to their name. To me, this is just managing the situation. So when you see the price dropping and the deliveries accelerating, it's almost as like, oh, are they just knocking down the paper price to quell that anxiety at the same time? Give it to me.
Right,
it's
get the best deal they can.
Yeah. And it's like jacking up the margin rates, which squeezed all the speculators. The price collapses, and then you see huge deliveries, like the December delivery, which was the biggest December delivery in the history of the COMEX market for the month of December. You're seeing price really, I think, being misdirection from global demand and from the understanding that gold and silver would be the place to be. And if they're going to knock it down for you, great. We'll stand for delivery at a better price. To me, it's the opposite of what they want you to think. But what you said is conventional wisdom. I mean, look, there still is the rule of law. But it depends how big of what are we talking? Are we talking physical gold held at Brinks? Sure. The U.S., I don't think will activate eminent domain. I think it would be far easier for them to go in and take SLV and GLD, which are controlled by JP Morgan and BlackRock, who JP paid the $920 million fine, the largest the Justice Department had ever issued at that point, for manipulating the metals market. It would be much easier for them to do that. I guess if I had to think of one country, and even they disappointed many years ago by closing out things with Viamet and all the Swiss banks, would be Switzerland. They have a history of that. But, you know, the real issue is that I don't think any government these days is really trustworthy. This is why you get the old adage, if you don't